Understanding monetary policy, types, definition, and examples. Monetary policy is a crucial tool used by governments and central banks to manage the economy's health and stability. It involves the control of the money supply, interest rates, and other financial instruments to influence economic activity. In this video, we will delve into the definition of monetary policy, explore its various types, and provide examples to illustrate its impact. Definition of monetary policy. Monetary policy refers to the actions taken by a country's central bank to regulate the money supply and interest rates to achieve specific economic goals. These goals typically include controlling inflation, stabilizing the economy, and promoting sustainable economic growth. Types of monetary policy. Expansionary monetary policy. This type of policy aims to stimulate economic growth by increasing the money supply and reducing interest rates. It encourages borrowing and spending, which leads to higher consumer demand and business investment. An example of expansionary policy is when a central bank lowers its benchmark interest rates to encourage borrowing for investment and consumption. Contractionary monetary policy. Contractionary policy is employed to slow down an overheating economy and control inflation. It involves decreasing the money supply and raising interest rates to discourage borrowing and spending. A central bank might use this approach when inflation is rising rapidly. For instance, if inflation is above the target level, the central bank may increase interest rates to curb excessive spending. Examples of monetary policy. Expansionary policy example. Imagine a country facing an economic downturn with high unemployment rates. To stimulate economic activity, the central bank decides to lower interest rates. This makes it cheaper for individuals and businesses to borrow money. As a result, people are more likely to take out loans for purchases, and businesses are more inclined to invest in new projects, ultimately boosting overall economic growth. Contractionary policy example. Let's say a country experiences a period of rapid economic growth, leading to high levels of inflation. The central bank decides to increase interest rates to discourage borrowing and spending. Higher interest rates make loans more expensive, leading consumers to cut back on purchases, and businesses to scale down their investment plans. This helps to slow down the economy and bring inflation under control. Conclusion. Monetary policy plays a crucial role in steering an economy towards stability and growth. By using tools like interest rate adjustments and controlling the money supply, central banks can influence borrowing, spending, and investment behavior. Whether it's to encourage economic expansion or curb inflation, understanding the different types of monetary policy is essential for anyone interested in the functioning of our economy. If you found this video informative and insightful, I invite you to consider subscribing to my YouTube channel, where I share more content on various economic concepts and their real-world applications. Thank you for watching and exploring the world of economics with me.